Forget the hot tips, forget the gut feelings. We're talking about the core playbook used by the most successful hedge funds in the world. It's a framework that turns trading from a gamble into a calculated business. Let's start with a crucial mindset shift. You're not paid for being right. You're paid for managing risk like a pro. Most retail traders are obsessed with finding the perfect entry, thinking that's the key to riches. But professionals know that a single trade is just one data point in a much larger game. The real money isn't made on one brilliant call. It's made through the disciplined execution of a system with a positive expectancy over hundreds or even thousands of trades. So what is this system? It boils down to three simple yet powerful words: setup, trigger, and management. Every single trade a professional takes follows this exact sequence. It's not an idea, it's an operation. Let's break it down. First up is the setup. This is the why. It's the underlying condition or thesis that makes a particular asset interesting to you. Think of it as the weather report before you decide to go sailing. Is the market trending upwards? Is a particular sector showing relative strength against the broader market? Is a stock approaching a historically strong support level after a pullback? The setup is your high-level context. It's the reason you're even looking at the chart. For example, a setup could be the overall market is in a confirmed uptrend and the technology sector is leading. I'm looking for strong tech stocks that have pulled back to their 50-day moving average. This isn't a signal to buy yet, it's just the condition that puts a stock on your radar. You're identifying a fertile ground where a high probability opportunity might grow. Amateurs jump in here. They see a stock they like pulling back and think it's on sale, and they buy. A professional waits. They know the setup is just step one. This brings us to the second and arguably most critical step, the trigger. The trigger is the when. It's the specific, observable, non-negotiable event that tells you, now is the moment the probabilities have shifted in my favor. It's the green light. While the setup is your strategic view, the trigger is your tactical entry signal. It has to be something you can see and define without ambiguity. For instance, continuing our example, the setup is the strong tech stock at its 50-day moving average. The trigger could be a specific candlestick pattern, like a bullish engulfing candle, forming right at that moving average on the daily chart. Or it could be the price breaking and holding above the high of the previous day's candle. The key here is that the trigger is mechanical. It removes emotion and discretion from the entry decision. You're not feeling like it's a good time to buy. You are waiting for the market to show you a predefined signal. If that signal doesn't appear, you don't trade. It doesn't matter how much you love the setup. No trigger, no trade. Period. This discipline alone will save you from countless impulsive, low-probability bets that drain your account over time. Now you've identified your setup, you've waited patiently for your trigger, and you've entered the trade. Is it time to sit back and dream about your profits? Absolutely not. Now the most important work begins. Management. Management is the how. How will you manage the position from entry to exit? This part needs to be defined before you ever enter the trade. Professionals know their exit plan for both a winning and a losing trade before they risk a single dollar. Management has three core components. First, where is your stop loss? This is your invalidation point. If the price hits this level, your trade idea was wrong, and you get out to protect your capital. It's not a suggestion, it's a rule. For our example, the stop loss might be placed just below the low of the bullish engulfing trigger candle. Second, where will you take profits? Are you targeting a specific resistance level, a 2-to-1 or 3-to-1 reward-to-risk ratio, or will you use a trailing stop to let the winner run as far as possible? There are many valid strategies, but you must choose one and stick to it for that trade. And third, how will you manage the trade in between? Will you move your stop loss to break even once the trade moves a certain amount in your favor? Will you scale out of the position, taking some profits off the table at your first target and letting the rest run? This is all part of the management plan. This three-part structure, setup, trigger, management, is the engine of a professional trading operation. But what fuels this engine? Data. Hedge funds are obsessed with probabilities. They constantly analyze the relationship between their win rate and their risk-reward ratio. Let me explain. You don't need to win every trade to be wildly profitable. In fact, many successful systems have a win rate below 50%. How is that possible? It's all about the risk-reward ratio. Imagine you have a system where you risk $1 on every trade. If your system wins 40% of the time, but on your winning trades you make $3, you have a highly profitable system. Let's do the math on 10 trades. You'll lose 6 trades, costing you $6, but you'll win 4 trades, making you $12. Your net profit is $6. That's what we call a positive expectancy system. Conversely, you could have a system that wins 80% of the time. Sounds great, right? But if on your 8 winning trades you only make 50 cents each, for a total of $4, and on your 2 losing trades you lose $3 each, for a total loss of $6, you're actually losing money over time. You have a negative expectancy despite your high win rate. Professionals don't trade ideas, they trade proven, back-tested systems with a positive expectancy. They know their numbers inside and out. They know that if they execute their setup trigger management plan flawlessly over a large number of trades, the statistical edge will play out in their favor. This is why they are so detached from the outcome of any single trade. A loss is not a failure. It's simply the cost of doing business. It's an expected part of the probability distribution. They're not emotional because the decision wasn't emotional. It was a systematic execution of a plan with a known statistical edge. So how can you start implementing this today? First, stop chasing hot stocks and start building a system. Define your ideal setup. So how can you start implementing this today? First, stop chasing hot stocks and start building a system. Define your ideal setup, back-test it, see how it would have performed over the last 100 times it appeared. Third, and most importantly, create a concrete management plan. Know your stop, know your target, and know how you'll manage the trade before you ever click the buy button. Write it all down, create a physical or digital playbook. Before every trade, check the boxes. Does this meet my setup criteria? Did my trigger signal occur? Do I have my management plan in place? If the answer to any of these is no, you walk away. This is the path from amateur speculator to professional trader. It's less exciting, it requires more discipline, and it feels more like running a business than gambling in a casino, because that is exactly what it is. You are the CEO of your own trading firm, and this playbook is your standard operating procedure. Start thinking in terms of probabilities, not predictions. Focus on flawless execution, not on being right. Embrace the setup trigger management framework, and you'll put yourself leagues ahead of the crowd. A question that separates the pros from the crowd. When do you ride the wave, and when do you bet against the tide? There's a famous saying in the markets, breakouts make traders rich, but reversals make legends. It sounds cool, but what does it actually mean? It points to the 2 fundamental ways traders approach the market, momentum trading and reversal trading. One is about following the herd with speed and conviction. The other is about standing alone, waiting for the exact moment the herd turns back. Mastering one can make you profitable. Understanding both can make you unstoppable. Let's start with the crowd favorite, momentum or breakout trading. This is the art of identifying a strong trend and jumping on board. Think of a stock that's been climbing steadily. It hits a key resistance level, a price it has struggled to beat before. Then suddenly it punches through on high volume. That's a breakout. A momentum trader sees this as a green light. The logic is simple. The force that broke the old ceiling is strong enough to push the price to new highs. This strategy is exciting, it's fast-paced, and when it works, the profits can be explosive. You're aligning yourself with the dominant market force. It feels powerful, like you've harnessed the market's energy. But here's the catch. The market loves to play tricks. What looks like a powerful breakout can often be a fake-out. The price pops above resistance, lures in all the eager breakout traders, and then immediately slams back down, trapping them in losing positions. So how do you trade breakouts with confidence? It's all about confirmation. A true breakout isn't just about price. It needs to be backed by evidence. First, look at volume. A genuine breakout should happen on a surge of volume, much higher than the recent average. This shows conviction. It tells you that big players are behind the move, not just a handful of overly optimistic retail traders. Second, look at the candle's close. Did the price just briefly poke its head above resistance, or did it close decisively above that level on a daily or 4-hour chart? A strong, confident close is a much better signal. And third, be patient. Sometimes the best strategy is to wait for the retest. After a breakout, the price will often pull back to test the old resistance level, which should now act as new support. If it bounces off this level and continues comportment, that's your high probability entry. You've confirmed the breakout is real, and you're entering at a much safer point. Discipline in momentum trading means not chasing every single pop. It means waiting for these confirmations, managing your risk sexual, and accepting that you will get caught in fake-outs sometimes. The goal isn't to be right every time. It's to make your winners big enough to dwarf your losers. Now let's talk about the other side of the coin, the path of the contrarian. Reversal trading. This is a much more subtle and psychologically demanding game. While the momentum trader is chasing strength, the reversal trader is hunting for weakness. They look for a trend that is overextended, exhausted, and ready to snap back. Think of a rubber band. You can stretch it and stretch it and stretch it, but eventually it's going to snap back. Reversal traders are trying to pinpoint that exact moment of maximum tension. They look for signs of exhaustion. This could be a series of smaller and smaller candles as a trend moves higher, showing the buyers are running out of steam. It could be a divergence on an indicator like the RSI, where the price is making a new high, but the indicator is making a lower high, signaling that the underlying momentum is fading. Trading reversals is like standing on a knife's edge. You are, by definition, fighting the primary trend. This is why it's said to make legends. Catching the absolute top or bottom of a major move can lead to some of the most profitable trades of your career. But get it wrong, and you're trying to stop a freight train with your bare hands. It can be incredibly painful. The psychology's case is completely different. Where a momentum trader needs to be aggressive and quick, a reversal trader needs to be patient and precise. You're not jumping in at the first sign of weakness. You're waiting for the trend to truly break. You need to see a clear shift in market structure. For example, in an uptrend, you want to see the price fail to make a new high and then break below its previous low. This is your confirmation that the tide has turned. Discipline for a reversal trader is about having an iron will. It's about not being early. It's about setting a very clear stop loss, because if you're wrong in a big way. And it's about understanding that you are playing a lower probability, higher reward game. You will have more losing trades than a trend follower, but your winners when you catch them can be monumental. So which one is better, breakout or reversal? The answer is neither. They are two different tools for two different market conditions. The best traders aren't just momentum traders or reversal traders. They are adaptable traders. They understand that markets move in cycles. There are periods of strong, clean trends where momentum strategies shine. And there are periods of choppy, range-bound action where prices swing back and forth, and reversal strategies are king. The real skill is learning to read the personality of the market on any given day. Is the market feeling directional and energetic? Then maybe it's a day to look for breakouts. Is the market looking tired and indecisive after a long run? Perhaps it's time to start stalking a reversal. Ultimately, your trading style has to match your personality. If you're someone who needs action and gets frustrated sitting on your hands, you might naturally lean towards momentum. If you're a patient, analytical person who enjoys solving complex puzzles, you might find reversal trading more appealing. My advice is to not pick a side. Instead, study both. Paper trade both styles. See which one resonates with you. But more importantly, learn to recognize the market conditions projetos for each. True mastery isn't about being a breakout trader or a reversal trader. It's about being a complete trader, one who can look at any chart and say, I know what's happening here, and I have a strategy for it. That discipline to wait for the right setup, whether it's a confirmed breakout or a broken trend line, is what separates consistently profitable traders from everyone else. It's not about being a hero or a legend. It's about being a professional. You've probably heard it 1,000 times. Never risk more than 1% of your capital on a single trade. It's the golden rule, the first commandment of trading, whispered in every forum and taught in every beginner's course. They say it's the secret to survival. And they're not totally wrong. The 1% rule will keep you in the game. It will keep you from blowing up your account on a bad day. But let me tell you something they don't. The 1% rule will almost certainly keep you from ever getting truly wealthy. Think about it. If you're starting with a modest account, say $5,000, risking 1% means you're risking just $50 per trade. Even if you're an amazing trader with a 2-to-1 reward-to-risk ratio, a winning trade nets you only $100. How many of those do you need to string together to see life-changing returns? After commissions and the inevitable losses, your account growth will be glacial. You're playing not to lose, which is a fundamentally different game than playing to win. Survival is the baseline, not the goal. The goal is to build wealth, to generate alpha, and for that you need a smarter approach to risk. So if the pros aren't blindly following the 1% rule, what are they doing? They're not just guessing, they're using sophisticated dynamic models. And one of the cornerstones of professional risk management is a concept called the Kelly criterion. Now, don't worry, we're not going to get lost in complex math, but the core idea is simple and powerful. Kelly's formula helps you determine the optimal percentage of your capital to risk on a trade to maximize long-term growth. What does it consider? Two crucial things: your win probability, how often you rewrite, and your win-loss ratio, how much you make when you win compared to how much you lose when you fail. Unlike the static 1% rule, the Kelly criterion is dynamic. It tells you to be aggressive when you have a high probability edge and to pull back when your edge is smaller. If you have a trading setup that wins 70% of the time with a 2-to-1 payout, the formula might suggest you risk 5%, 8%, or even more of your capital. Conversely, if your edge is slim, it will tell you to risk far less than 1%, or perhaps not trade at all. It's about sizing your bets according to the quality of the opportunity, not a one-size-fits-all rule. Now, a quick disclaimer. Using the full Kelly formula can be very aggressive and lead to huge drawdowns. Most professionals don't use the full Kelly. Instead, they use a fractional Kelly, like half Kelly or quarter Kelly. This gives them the benefits of dynamic position sizing, betting bigger on better opportunities, while smoothing out the gut-wrenching volatility. They get the intelligence of the model without the extreme risk. It's about adapting a powerful concept to fit your personal risk tolerance. The principle remains: your risk should be proportional to your proven statistical edge. But it gets even more nuanced than that. Real fund managers understand that risk isn't just about their trading setup, it's also about the market itself. This is where the concept of volatility comes in. Volatility is just a measure of how much the market is swinging around. When markets are calm and predictable, like a gentle stream, you can afford to take on larger position sizes. Your stop loss can be tighter, and the path to your price target is clearer. In this environment, a 2% or 3% risk might be perfectly reasonable for a high-conviction idea. However, when the market turns into a raging river during a major news event, a financial crisis, or just a period of high uncertainty, everything changes. Price swings become wild and unpredictable. A stop-loss that was safe yesterday is now easily triggered by random noise. What do the pros do? They don't just stick to their guns. They dynamically scale down their risk. They recognize that in a high-volatility environment, the probability of being stopped out by sheer randomness increases dramatically. So, they reduce their position sizes. Maybe they go from risking 2% per trade down to 0.5%. They are protecting their capital not from their trading idea being wrong, but from the chaotic market environment. They trade smaller to stay in the game, waiting for the storm to pass and for calmer waters to return. This is the opposite of how most retail traders behave. Amateurs get emotional. When the market is ripping higher and they have a bad case of FOMO, they get greedy and increase their risk, often at the market top. When the market is crashing and fear is everywhere, they panic sell or are too scared to take even a small, calculated risk at the bottom. Professionals do the exact opposite. They manage risk based on data and volatility, not on feelings of greed or fear. Their risk management system is objective. It tells them when to press the accelerator and when to pump the brakes, completely independent of their emotional state. Let's put this all together into a practical framework. How can you move beyond the 1% rule and start trading more like a professional? First, you need to know your numbers. You must meticulously track your trades. What is your actual win rate? What is your average reward to risk ratio? Don't guess. You need hard data. Without this, you can't calculate your edge, and you're just gambling. Use a trading journal. After at least 50 to 100 trades, you'll have a baseline understanding of your performance. Second, based on your data, you can start using a fractional Kelly approach. You don't need to be a math genius. There are simple online calculators where you can plug in your win rate and reward risk ratio, and it will suggest an optimal bet size. Start with a very conservative fraction, like a quarter Kelly. The goal isn't to instantly 10x your risk, but to begin thinking dynamically. As you see a high-quality setup that fits your proven strategy, you might risk 1.5%. For a setup that's decent but not perfect, you might risk 0.75%. You are now letting the quality of the trade dictate your risk. Third, pay attention to market volatility. A great tool for this is the VIX index, often called the fear index. When the VIX is low and trending down, the market is generally calm. This might be a green light to use your standard risk parameters. But when the VIX spikes, indicating fear and uncertainty are rising, that's your signal to reduce your size across the board. You could decide, for instance, to cut all your position sizes in half whenever the VIX goes above a certain level, say 25 or 30. This isn't a perfect science, but it's a systematic rule that protects you from volatile chop. Ultimately, risk management isn't about playing safe, it's about playing smart. The 1% rule is a useful training wheel for a beginner on a tricycle. It stops you from falling over, but you will never win the Tour de France on a tricycle. To compete at a higher level, you need to upgrade your vehicle and your skills. You need a system that allows you to be aggressive when you have a clear advantage and defensive when the odds are murky. Real wealth isn't built by taking 1,000 tiny, identical steps. It's built by taking calculated, appropriately sized strides, sometimes leaping when the opportunity is golden, and other times standing still when the path is treacherous. Stop treating risk as a static, scary number. Start seeing it as a dynamic tool, your most powerful tool for capital growth. Track your data, understand your edge, and adjust your risk based on the quality of your setups and the state of the market. That is how you transition from just surviving in the markets to truly thriving. What's the real fear on Wall Street? You might think it's losing money, watching your portfolio bleed red, but that's a rookie's fear. For the titans of finance, the real terror is something far more subtle, something that keeps them awake at night far more than a single bad trade. It's losing their edge. Welcome to the world where trading stops being a game of charts and numbers and becomes a brutal war of perception, psychology, and emotional control. In the high-stakes arena of hedge funds and institutional trading, fear doesn't just disappear, it transforms, it evolves. The fear is no longer about the simple loss from a trade gone wrong. It's about losing positioning, it's about losing timing, it's about losing an informational advantage. Let me put it this way. Professionals aren't terrified of red days on the screen. They're terrified of being late to the party. They're terrified of being the last to know, the last to act. Think about the fundamental difference here. Retail traders, the amateurs, are paralyzed by the fear of being wrong. They want every trade to be a winner, to validate their analysis and their ego. But professionals, they fear being slow. They understand that in a market that moves at the speed of light, being right but late is the same as being wrong. Speed of execution, speed of information, speed of decision-making, that is their currency. Amateurs are constantly chasing safety. They're looking for the guaranteed win, the low-risk bet, the comfortable trade. They want certainty in a world defined by uncertainty. But Wall Street chases something entirely different. They chase asymmetry. They hunt for those rare, beautiful moments where the potential upside is practically infinite and the downside is calculated, known, and managed. It's not about avoiding risk. It's about finding risks where the reward overwhelmingly justifies the danger. This, my friends, is the core psychology of smart money. They don't seek certainty because they know it's an illusion. Instead, they seek a statistical advantage. A small edge, compounded over thousands of trades, becomes a massive fortune. They don't try to fight fear or pretend it doesn't exist. They harness it. Fear becomes their radar, not their cage. A spike of fear isn't a signal to panic and sell everything. It's a signal to pay closer attention. It alerts them to danger, to an imbalance in the market, and most importantly, to a potential opportunity that everyone else is too scared to see. For a professional, a losing trade is just a business expense. It's the cost of gathering information from the market. It doesn't define their skill or their worth. You know what does? Losing discipline. A single trade where they break their own rules, where they let emotion dictate their actions, that is the ultimate failure. Because in their world, market chaos is a given, it's constant. But self-control, the ability to stick to your process when your heart is pounding and your mind is screaming, that's incredibly rare, and that rarity is their advantage. The real game, the one played for billions of dollars, is a game of psychological detachment. Top traders don't fall in love with their stocks. They don't get angry and hate the trend when it goes against them. They certainly don't argue with the market's verdict. They treat the market like a force of nature, like the weather. You don't get mad at the rain, you just grab an umbrella. They respect the market's inherent randomness, and they dedicate their lives to exploiting its underlying structure and patterns. This is why smart money thrives on uncertainty. While the crowd is panicking, desperate for someone to tell them what will happen next, the professionals are calm. They aren't trying to predict the next single move. That's a fool's errand. Instead, they prepare for every move. They have a plan for the market going up, a plan for it going down, and a plan for it going absolutely nowhere. Every possible scenario is calculated, and every reaction is rehearsed. They know with absolute certainty that controlling the outcome is impossible, but controlling their own reaction, that is everything. That is the only thing they can control, and so they master it. At the highest level of this game, trading becomes an internal battle. It's a constant struggle between your ego and the evidence on the screen. It's a fight between your gut impulse and your tested process. It's the war between the primal need to win every single battle and the strategic need to survive the entire war. The moment you place a trade seeking validation, seeking to prove you're smart, you have already lost. The market is the ultimate ego crusher, and it will humble anyone who comes to it looking for a pat on the back. The shift happens when you stop fearing financial loss and start fearing the loss of your own discipline. When a broken rule scares you more than a red number on your screen, you cross a psychological threshold that very few ever reach. That is the moment you stop trading for money and you start trading for mastery. You begin to focus on perfect execution, not on the random outcome of a single trade, because in the end, the long-term winners on Wall Street aren't the clairvoyants who can predict the future. They aren't the gamblers who get lucky on one big bet. They are the survivors. They are the ones with the discipline and the psychological fortitude to stay in the game, long after the emotional, impulsive, and undisciplined crowd has been wiped out and has disappeared. They win by outlasting everyone else. Thank you so much for watching. If this perspective on trading psychology resonated with you, do me a favor and hit that like button and subscribe for more content that goes beyond the charts. I'll see you in the next video.